Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sentinelone Inc. Annual Report. Sentinelone Inc. provides a wide range of cybersecurity services and solutions to protect organizations from various cyber threats. The company's flagship product, the Singularity Platform, offers artificial intelligence-powered autonomous threat prevention, detection, and response capabilities across endpoints, cloud workloads, and identity credentials. In addition to its core platform, Sentinelone also offers several other services, including generative AI security agents, security information and event management, endpoint security, cloud security, and identity security. The company's offerings also include exposure and vulnerability management, as well as threat services designed to help organizations stay ahead of emerging threats. Overall, Sentinelone's comprehensive suite of cybersecurity solutions enables seamless and autonomous protection against a broad spectrum of cyber threats, making it an attractive option for organizations seeking robust security measures. Sentinelone Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Sentinelone Inc. trades at a higher price-to-book ratio of 3.33 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 31% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified by examining various factors. On the growth side, sales of subscriptions to the Singularity Platform, additional modules, premium support services, distribution through resellers, and variable consideration based on transaction volume are key contributors. These revenue streams have been instrumental in driving growth for the company. On the other hand, foreign currency transaction losses, service-level commitment credits, and a decrease in international revenue from Israel and the rest of the world have contributed to revenue decline. The fluctuations in foreign currency exchange rates also pose a risk to revenue stability. Furthermore, the company's exposure to foreign currency risk through its ITA liability and undesignated forward contracts adds to this uncertainty. The acquisitions made by the company, such as Observo and Prompt Security, have also had an impact on revenue growth. The goodwill and intangible assets resulting from these acquisitions are expected to contribute to future operational synergies and assembled workforce. However, the cost of revenue has decreased, while research and development expenses have increased, indicating a shift in priorities for the company. Overall, the drivers of revenue growth or decline are multifaceted and influenced by various factors, including sales performance, foreign currency fluctuations, acquisitions, and operating expenses. The net income of the company experienced a significant decline between 2025 and 2026. The net loss increased from -$288.4 million to -$450.7 million, indicating a substantial deterioration in financial performance. This downturn can be attributed to various factors. One major reason for this decline is the decrease in profit margins. As operating expenses exceeded revenue growth, the company's ability to maintain profitability was compromised. Furthermore, reduced revenue and gross margin, coupled with increased net losses, contributed to the decline in profit margins. The potential impact of investments in AI technology on gross margins also poses a threat. The reasons behind these changes are multifaceted. Limited operating history, increased operating expenses, and the potential inability to achieve or sustain profitability have all played a role. Additionally, increased competition and reduced revenue growth have further exacerbated the situation. The company's difficulty in increasing market penetration of its platform, coupled with potential price reductions and fewer orders, has also contributed to this decline. The company is generating positive operating cash flow, indicating a healthy financial position. The data from various sources confirms this trend, with the company reporting net cash provided by operating activities of $76.6 million and $33.7 million for fiscal years 2026 and 2025, respectively. These figures demonstrate that the company's operations are generating sufficient cash to cover its expenses and investments, resulting in a positive operating cash flow. This is a significant indicator of the company's financial stability and ability to sustain its business activities. The recent market analysis reveals a mixed performance across various segments. Internationally, markets have struggled, indicating a decline in overall growth. In contrast, Israel has shown resilience, successfully resolving long-standing tax disputes with the Israeli tax authority. This achievement highlights the country's ability to navigate complex regulatory issues and maintain a favorable business environment. Domestically, while there are no reports of poor performance, challenges persist in hiring and retaining sales personnel. This suggests that companies may be facing difficulties in attracting and retaining top talent, which could impact their overall market presence. Management's outlook and strategy. A focus on long-term growth, the company's management has outlined a clear strategy for navigating the challenges of rapid growth amidst global macroeconomic and geopolitical conditions. Key to this approach is investing in research and development, with expenses increasing significantly over the next 2 years. This focus on innovation will enable the company to expand its product offerings through strategic acquisitions, such as Observo and Prompt, which complement existing products and enhance the data business portfolio. Management's emphasis on long-term relationships is also evident in the company's contracts with customers, which typically range from 1 to 3 years. This approach allows for sustained revenue growth and minimizes the impact of short-term market fluctuations. Furthermore, management has prioritized stock-based compensation for executives, aligning their interests with those of shareholders. To support its growth strategy, the company has implemented a share repurchase program, aiming to purchase up to $200 million of its outstanding shares. Additionally, restructuring plans have been initiated in 2023, 2025, and 2026 to reduce operating costs, improve margins, and drive profitable growth. While the company expects operating losses to continue for the foreseeable future, management remains committed to advancing its commitment to profitable growth. By prioritizing investments in research and development, expanding product offerings, and minimizing tax liabilities, the company is well positioned to navigate the challenges of a rapidly changing market. The company has made significant moves in its business strategy through acquisitions and divestitures. In September 2025, 2 notable acquisitions were made: Prompt Security Inc., Prompt, and Observo Inc., Observe. These acquisitions are expected to bring new capabilities and expertise to the company. However, it's worth noting that not all acquired assets remain with the company. One of its divestitures includes the sale of intangible assets from Prompt to the U.S. This move suggests a strategic decision to focus on specific areas while shedding non-core assets. The company's capital return policies have been evident over the past few years. One notable aspect is its decision to repurchase common stock, a move that has been made twice in recent times. In fiscal 2026, the company spent $200 million on buying back shares, with a total of 12.2 million shares being acquired for this amount. However, it's worth noting that the company has not paid dividends to its shareholders. According to the company's policies, common stockholders are entitled to receive any declared dividends by the board of directors. Despite this entitlement, no dividend payments have been made in recent years. Concerns about inventory buildup or supply chain disruption are evident throughout the provided text. On pages 26 and 27, potential concerns include supply chain disruptions, labor shortages, government shutdowns, global economic slowdowns, interest rate volatility, and increased risk of inflation. These factors can lead to reduced sales due to supply chain disruptions. Supply chain disruptions are also mentioned as a concern on page 56. While there is no specific mention of inventory buildup, the potential for component shortages and pricing increases from cloud hosting providers could indirectly contribute to inventory issues. However, it appears that these concerns are more related to technical failures or external factors rather than inventory management itself. Overall, while there are some indirect mentions of potential inventory-related issues, supply chain disruption is a clear concern across multiple pages. That concludes the financial summary for Sentinelone Inc. Feel free to comment below, and I will be happy to answer them when possible.